Welcome to today's analysis. We are unpacking a massive, ground-shaking paradigm shift right now. I mean, it is completely upending the software market as we know it. If you've been watching the markets, you already know things have been incredibly volatile lately, especially in tech. But listen, what we're witnessing right now, it isn't just a regular market hiccup. It's a fundamental rewiring of how businesses literally operate, and it's driven entirely by artificial intelligence. We're going to break down exactly what this AI shift means, looking at the data to understand where the real value actually lies moving forward.
Okay, let's dive into this. Since the collapse that kicked off around January, we've seen software shares just plummet, dropping anywhere from 30% to a massive 80% over the last 6 months. I mean, that is a breathtaking destruction of value in a sector that most people thought was virtually untouchable. It's exactly the kind of drop that makes investors panic and sends analysts scrambling. But massive market dislocations like this, they're rarely just blind panic. They usually signal a deep underlying change in the whole business landscape. Which naturally brings us to the million-dollar question. Is this massive dip a giant warning sign to stay away, or is it a generational buying opportunity? Well, to answer that, we can't just look at the software sector as one big monolith anymore. The AI revolution is splitting the market right down the middle. So today, we're going to use a shift and sort framework. Basically, we're going to sort through the wreckage to separate the legacy models that are frankly doomed from the next generation models that are absolutely booming.
Section 1. The losers. What to avoid.
Now, what's really interesting about this slide is the cautionary tale it tells. Before we look at what to buy, we really need to know exactly what to avoid, right? There's a specific category of legacy software that is being entirely disrupted by new AI capabilities, and catching a falling knife here, well, it could be disastrous for your portfolio. Historically, businesses paid massive premiums for software as a service, or SaaS, analytics. These companies would take your database, slap a shiny interface on it, and charge you by the seat for every single user who wanted to pull a report. But guys, that model is done. Today, users are totally abandoning those expensive per-seat analytics. Why? Because you can simply plug your database directly into an application layer like Clouder or OpenAI. Anyone in the company can just type in normal, everyday language to ask whatever questions they want, instantly creating their own custom reports and dashboards. I mean, nobody is going to pay by the seat for analytics anymore when AI can do it for practically nothing. Analytics SaaS as a standalone business is definitely losing its edge.
Moving on to Section 2. The winners. The cybersecurity boom.
But as one door closes, another one bursts wide open. We are entering an era of unprecedented digital vulnerability, which makes the cybersecurity sector the absolute undisputed beneficiary of this AI revolution. To really get why cybersecurity is booming, you have to understand the terrifying acceleration of threats. Previously, a sophisticated hacker might take a year or two to execute a complex, coordinated cyber attack against a bank or a government entity. Not anymore. With advanced AI models, like the Mythos model from our source material, attackers can compress 1 or 2 years' worth of highly sophisticated cyber attacks into just 3 days to 1 week. It's wild. The sheer volume and speed of attacks on everyone, banks, governments, businesses, is going straight up. And because these attacks are exponentially increasing, cybersecurity firms are going to get paid exponentially more to prevent them.
And it doesn't stop at digital data. The total addressable market, or TAM, for cybersecurity is multiplying by 10x. It's not just big banks anymore. It's spilling over into the physical world. Think about the rise of physical AI. Smaller businesses and entirely new verticals are suddenly going to need enterprise-grade security. Why? Because the stakes are literally physical now. Think about it. A hacked self-driving car ramming into a pedestrian? That's a life-or-death problem. An AI-guided dentist tool getting hacked and malfunctioning while it's inside your mouth? Okay, that is a terrifying problem. These physical AI applications use a ton of software, and they absolutely must be protected. This means smaller businesses, clinics, manufacturers, they're all going to start paying massive premiums to cybersecurity firms. So, the crucial point is this. Picking up top-tier cybersecurity firms while their stock prices are temporarily dragged down by the broader software crash, that could be a highly lucrative move. Based on the market dynamics we just covered, companies like Zscaler, Palo Alto Networks, and CrowdStrike are perfectly positioned to flourish. They already have the infrastructure to handle this 10x surge in demand from both existing enterprise clients and those entirely new physical AI verticals.
Section 3. The winners. Data and databases.
Alongside cybersecurity, the next major boom comes down to the raw fuel of AI, data. The AI shift is creating just an unprecedented explosion in raw information, completely changing how we think about databases. Let's move to and see how this builds.
Historically, databases were populated by humans. A human would do a sales call, and then that human would manually type the notes into the system. But look at this new workflow. We are transitioning to a world where AI agents are doing the heavy lifting. Step 1. AI agents are actually conducting the sales calls. Step 2. AI agents are writing the code and generating product updates. Step 3. AI agents are automatically creating the system of record. The entire enterprise workflow is shifting from human-led data entry to machine-led, instantaneous data generation.
And because machines don't sleep, they don't take breaks, and they process information instantly, we are staring down the barrel of a staggering statistic. The amount of data that enterprises will create just this year alone is expected to be 10 times the amount of data created globally up until last year. I mean, let that sink in for a second. It's a 10x data explosion. Every single action an AI agent takes generates logs, analytics, and records. And all of that data has to be stored, collated, and arranged somewhere.
This directly connects that 10x data explosion to our next group of clear beneficiaries. Any company focused on data collation, arranging, and database management is positioned to do incredibly well as the sheer volume of data just goes exponential. The top picks in the space, the ones positioned to capture this massive wave, include companies like Snowflake, MongoDB, and Databricks. They provide the highly scalable infrastructure required to house the massive data sets that AI models both generate and constantly rely upon.
Section 4. The AI orchestrator opportunity. We've covered security and storage, but right now, a lot of these databases are highly fragmented. The next big opportunity lies in unification. Think about it from the perspective of a CEO. You've got all these disjointed databases scattered across your company. You have your cloud infrastructure. What you really want is to bring all of this together seamlessly so you can just ask a question and generate your own reports on the fly. In the next 2 to 3 months, highly capable open source models are going to hit the market. People are going to take these models, train them, and use them to bridge these exact gaps. The software companies that realize this early and reinvent themselves as orchestrators, unifying these disjointed databases into one cohesive, easily queryable system, they will become absolutely essential to the modern enterprise. So definitely keep an eye out for current software companies adapting to this orchestrator role, and, of course, brand new startups emerging to fill the void. Section 5. The safe play. ETFs. You might be looking at all of this, the collapse of legacy SaaS, the rise of cybersecurity, the massive database explosion, the new orchestrator opportunity, and thinking, picking individual stocks is just too risky. And that is a completely valid perspective. So here's a more conservative strategy for investors who want exposure to this massive AI shift without betting the farm on single stocks, the ETF route. And this brilliantly illustrates how buying a software exchange-traded fund, something like the IGV ETF, lets you buy a whole basket of top software companies. This allows you to safely play the broader open source and data orchestration movement. As the overall market rebounds and these companies adapt to the AI era, an ETF gives you broad exposure to the sector's recovery while mitigating the risk of any single legacy SaaS company dragging down your entire portfolio. We have covered a tremendous amount of ground today, looking at the mechanics behind the software stock crash and the explosive new opportunities AI is creating. We've seen how legacy SaaS is fading, while cybersecurity, massive databases, and AI orchestrators are stepping right into the spotlight. So as we wrap up this analysis, I want to leave you with a provocative question to really consider for your own strategy. Take a hard look at where your capital is deployed right now. Are your investments still clinging to the per-seat SaaS models of the past? Or are they truly ready for the high-speed agentic future of AI databases and critical cybersecurity? Think about it and keep learning.